Now let's look at futures contracts. So what is a futures contract? Well, a futures contract is very similar to a forward contract in that it's an agreement to exchange an underlying asset for a pre-specified price at a specific date in the future. However, there are some major differences. First, futures contracts aren't customized, they're standardized. They also trade on derivatives exchanges like the CME or ICE. Futures contracts also involve depositing something called an initial margin that we'll explore in more detail. Finally, futures contracts are marked to market daily, which can lead to margin calls, and we'll explain that as well. So let's get going. Futures contracts, like forwards, can be used for hedging. However, futures contracts are often more attractive for speculating than forwards, and it's because of two key characteristics of a futures contract. First of all, futures contracts offer liquidity because they're traded on exchanges. Futures contracts also have leverage through margins, which we'll explore later. Futures contracts have several key components. First of all, the contract needs to stipulate the underlying asset, whether that be a stock index, a commodity, a currency, and so on. A futures contract will also have an expiration date, often quoted in months. We will need to agree the specified price up front, just like a forward contract. The contract size will be standardized. So contracts for oil, for example, are standardized at 1,000 barrels per contract. Futures contracts also need to stipulate the type of delivery, whether that be physical delivery or cash settled. There's also something called the tick size, which is the minimum increments that the price will move by. And again, we'll see that in more detail a bit later on. And finally, we've mentioned margin several times. And a futures contract will stipulate both something called an initial margin and a maintenance margin. Similar to a forward contract, a long position in a futures contract benefits the higher the price of the underlying asset, whereas a short position on a futures contract will benefit from a lower price of the underlying asset. If we look at the profit and loss diagram for a long position on the left, we see that it matches in many ways the underlying asset price. As the underlying asset price goes up, so does the profit associated with the futures contract. Now let's look at a real futures contract. This futures contract is for gold. We'll start by looking at the delivery date. That, in this case, says Feb 20 or February 2020. This is the date in the future that the transaction will occur. Next, let's look at the contract size. In this case, each contract is for 100 troy ounces of gold. So you can't buy 1 ounce of gold in the futures market. You have to buy increments of 100 troy ounces. Next, we can look at the tick size. The tick size is the minimum price fluctuation per troy ounce. For this gold contract, the price moves in increments of 10 cents. As the contract is for 100 troy ounces, the minimum price fluctuation per contract is 100 troy ounces times 10 cents or $10. Next, you'll see the price. This is the agreed futures contract price. Gold is quoted per troy ounce, so the contract value is $1,518.80, but times 100 troy ounces. So the true contract value is actually $151,880. At the very bottom of the Bloomberg screen, you'll see the margin requirements, and you'll see both something called an initial margin and a secondary margin. The initial margin is the amount of money that needs to be deposited with the exchange to open a buy or sell position on a futures contract. And we'll explore more about margins later in this course. A major difference between forwards and futures is that futures contracts are settled daily. A counterparty's margin account is credited or debited as the spot price of the underlying asset changes. If, for example, the margin account of the buyer or seller falls below a certain point, known as the minimum required margin or secondary margin, a margin call will happen. The counterparty is required to then deposit more money into the margin account to retain their position. And we'll work through an example so you know exactly how margin accounts work in practice. We're going to calculate together the margin requirements for the following contract. We're going to assume we're looking at an oil futures contract that's going to be delivered 3 days from now. The futures price in the contract is $50 per barrel, and the contract size is 1,000 barrels. Now, at the bottom of the screen, you'll see that we're actually going to be trading 10 contracts, so in fact 10,000 barrels, but each contract is for 1,000 barrels. The tick size is 1 cent, which means that the price of oil on this futures contract will move in increments of 1 cent. However, because we're always trading in increments of 1,000 barrels, a change of 1 cent per barrel actually translates to a change of $10 per contract. Because this is a commodity future, the delivery will be physical. We'll actually physically deliver the oil. Now, we want to focus on the margins. There are 2 margins listed here, an initial margin and a maintenance margin, sometimes referred to as a secondary margin. So what do these really mean? So I'm going to use a bank account analogy first before we move on and do some detailed calculations. So if you want to think about a bank account, the initial margin would be the amount that the bank says you have to deposit just to open a new account. In this case, for the futures contract, then what we're saying is to open the futures contract, the counterparties have to deposit $5,000 each per contract with the exchange. So because there are 10 contracts, each counterparty needs to deposit with the exchange $50,000. The maintenance margin here is $3,000. You can think of a maintenance margin like the minimum balance you need to keep in a bank account. So in our scenario, we are saying to open the futures contract, you need to deposit $5,000 per contract with the exchange. However, you also need to make sure that the minimum balance in the margin account with the exchange never drops below $3,000. If the margin account does drop below $3,000, the counterparty will be asked for a margin call. Let's look at this now in more detail. Okay, so let's look at this in a bit more detail, and then we're going to move to Excel and build a small working model that actually calculates the margins for us. The exposure for both counterparties on the contract is $500,000. We get that by taking the futures contract price of $50 a barrel times 1,000 barrels per contract and then multiply that by 10 contracts. The tick value, which we've already talked about, is 1 cent per barrel, but we also know that each contract is 1,000 barrels, which means the value of the contract moves in increments of $10. But because we have 10 contracts, really the value of our contracts is moving in increments of $100. Now let's remind ourselves of the margins. Each counterparty will need to deposit with the exchange $5,000 per contract. But because there are 10 contracts, the counterparties need to deposit $50,000 each with the exchange. Each counterparty also needs to make sure that their margin account at the exchange never drops below $30,000. That's $3,000 per contract times 10 contracts. Now that we have confirmed the fundamentals, let's look at how this works in practice. In a moment, we'll be doing this in Excel. But for now, I want to highlight just a couple of things. First of all, we're going to assume that the price at the end of each day moves as follows. We start the contract, the day the contract was signed, let's just assume that the price of a barrel of oil was $50. But then at the end of day one, the price went up to $51.10. At the end of day two, the price dropped to $47.50. And then on day three, the day that the contract is delivered and the contract expires, the price of oil moves to $50.20. Instead of talking to the numbers here, let's now move to Excel and we'll build a small working model. Okay, let's calculate margins by building a small model that will calculate whether there will be a margin call. This contract is for 3 days, and the prices are captured here in row 26. Just a quick reminder, everything that's blue font is an input, and everything that's in black font is a formula. So I've already also calculated the daily price movements in row 27. And I've also entered where our margin account starts, and that's the initial margin, which is deposited with the exchange, which is $5,000 per contract times 10 contracts. Next, I'm going to calculate the number of ticks that the price has moved each day. We do this by taking the price movement and just dividing it by the tick size, which is 1 cent a barrel. That gives me 110 ticks. Now, because I want to copy this across, what I'm going to do is I'm going to lock cell C21 with dollar signs, and then I'm going to copy this across. Knowing the number of ticks allows us to quickly calculate changes in our profit and loss. Because if we know the number of ticks, in this case it went in our favor, we just take the number of ticks times the tick value per contract, which is C22, and I'll lock it down with dollar signs, times the number of contracts, which is 10, which is C15, and I'll lock that down with dollar signs. That's $11,000, and I'll copy that across. So what will happen on day one is $11,000 will be deposited into our margin account. So we'll have our opening balance of $50,000 plus what is being deposited or withdrawn from our account. In this case, $61,000. The next thing we need to do is calculate whether there will be a margin call, and we'll use an if statement. And what we want to do is type something like this, equals if this amount, in this case 61,000, is less than the minimum maintenance margin, which is 30,000, but I need to lock that down, then we're going to get a margin call. And the margin call is going to be what's the amount that we need to deposit to go back up to the original initial margin of $50,000. So it's going to be what's the 50,000, which is C19. I'm going to put a dollar sign around that, minus what the amount is before the margin call, which is C31. And we want to put another comma there, because if the margin account is higher than the 30,000, then there's no margin call. I'm going to copy that across in a moment, but we know there will be no margin call here because, of course, the margin account is not below 30,000. In fact, it's gone up. So in cell C33, I'm just going to add total before margin call with the margin. I'm then going to highlight the deposited amount, which in this case was the original 50,000. And that allows me to calculate my profit and loss at the end of the day. I just take the ending margin account minus what I originally had in the margin account. Now let's do day two. Day two, we start in the margin account with 61,000. So I'm going to link that to day one. But then we're going to have 36,000 withdrawn from our margin account. So that's going to be the 61,000, and I'm just going to put a plus sign plus what has changed. And that means we only have 25,000 left in the margin account. We know, therefore, that we have to deposit another 25,000 to bring us back to the initial margin. I'm going to copy my formula across. There's the 25,000. That means that we'll now end up back with the 50,000. What we deposited, though, now is the 50,000 plus another 25,000. And if we copy the formula in cell C35 across, you can see we're now sitting on a loss of $25,000. Finally, we can go to day 3. Day 3 opening balance is going to be the balance or the ending balance from the day before. The total before the margin call is going to be the $50,000 plus $27,000. I'm just going to copy that across. So now we're sitting at $77,000. There won't be a margin call. We'll copy the formula, make sure that says 0, which is telling us that the formula is working. Our ending margin account, we can copy across as well. That's what will be at our end of day. How much was deposited? Well, what was deposited? We don't have any extra margins, so what was deposited is $75,000. And our profit and loss at the end will be $2,000. How are futures prices calculated? Well, let's work through an example. Imagine that you plan to buy 1,000 barrels of oil in 1 year's time. That's when you actually need the oil. There are 2 strategies you could consider. Strategy 1 would involve you buying the oil now, even though you don't need it now, and then storing it for a year until you need it. The costs associated with this strategy would be, first of all, we need to borrow money to buy the 1,000 barrels of oil. And we also will need to pay interest on that loan, and we'll also have to pay storage costs. So we can think of the cost of this strategy as the spot price, the price of a barrel of oil, plus 2 carry costs. We have the cost of interest on the loan, plus we have storage or warehousing costs. For some futures, there can be an underlying asset that provides a carry return. So the formula you see here is the full formula, the spot price plus the carry cost minus the carry return. An example of a carry return on a buy and hold strategy would be a bond. If you held a bond for a year, you would be entitled to a coupon or interest payment. You would have a cash flow coming in. That's an example of carry return. For our 1,000 barrels of oil, however, we only have carry costs and the spot price. The other strategy would be to simply buy a futures contract for 1,000 barrels of oil that actually expires in 1 year's time or matures. The cost in this scenario would simply be the cost of the futures contract. Let's put some numbers to our example. Let's start by assuming that the spot price of oil is $50 a barrel. The cost of borrowing is 5%, and the cost of storing 1,000 barrels of oil is $2,000. Let's also assume a 1-year futures contract is priced at $55 a barrel, or $55,000 per contract. Let's look at these 2 strategies. So strategy 1 is to buy now and hold. So the cost associated with this strategy is the spot price, which is $50 a barrel times 1,000 barrels, plus a loan of $50,000 or $50 times 1,000, but also times the 5%. We also have to add the storage cost of $2,000, but as already mentioned, there's no carry return, so we'll just put a 0 there. The cost of this strategy is therefore $54,500. Strategy 2 is more straightforward. It just entails buying a futures contract, and the cost will be the futures contract price, in this case, $55,000. If this were the case of strategy 1 and strategy 2, what could an investor do to profit from the situation? If the spot price and futures price are not in equilibrium, there's an arbitrage opportunity. We could execute strategy 1, which is to buy now and hold, and we know the cost of that strategy. We've calculated the cost at $54,500. At the same time, though, we could enter into a futures contract. We wouldn't buy a futures contract, we'd sell a futures contract, which would give us cash of $55,000. Taking the cash from selling the futures contract of $55,000 and minus our cost of strategy 1 of $54,500 leaves us with a profit of $500.